Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are slightly down today. Dow Jones down 0.2%, S&P 500 down 0.4%. Oil prices are at $65 per barrel. Yield curve is up quite a bit. 10-year Treasury yield is up 4 basis points. 5-year Treasury yield is up 6 basis points on the back of initial jobless claims that we're going to talk about in a little bit. Let's switch to the daily article. Wall Street indices hit one-week low as investors reassess rate cut expectations. Wall Street's main indices fell to their lowest in a week on Thursday as fresh economic data and remarks of a Federal Reserve official tempered optimism around further rate cuts. Initial claims for state unemployment benefits dropped 14,000 to a seasonally adjusted 218,000 for the week ended September 20th. Data from the Labor Department showed. Economists polled by Reuters forecast 235,000 claims for the latest week. The real question will be, now that the jobless data is less bad than originally anticipated, does that mean the Fed might not cut rates in October and December? Said Sam Stovall, chief investment strategist at CFRA Research. Investors scaled back their expectations of a 25 basis point rate cut in the Fed's October meeting to 83% from about 92% on Wednesday, according to the CME FedWatch tool. The U.S. Central Bank lowered interest rates by 25 basis points last week, its first cut since December, and had signaled more reductions ahead. But Chicago President Austin Goolsbee said on Thursday he was uneasy with cutting rates too quickly, flagging risks about inflation flaring up. In other news, communication services stocks fell 1%, pressured by Alphabet and Meta Platforms down 1.7% and 1.4%, respectively. The pullback underscores the fragility of the September rally, revealing how sensitive markets remain to even subtle shifts in economic indicators and Fed messaging. With valuations still high, equities are vulnerable to any signs that the Fed may slow its pace of easing rates. That makes the upcoming economic data crucial in shaping market sentiment. Investors are now focused on Friday's release of Personal Consumption Expenditures Index and the Fed's preferred inflation measure, which could determine expectations for the path of interest rates. A potential government shutdown in Washington, where budget negotiations have so far failed to yield an agreement, only aggravated the worries. Analysts warned that the prolonged shutdown could disrupt data releases critical for assessing economic trends, injecting fresh volatility into an earlier or uncertain backdrop. Among stocks, CarMax hit more than a 5-year low, sliding to the bottom of the S&P 500 after the used car retailer reported lower second quarter profit. We're going to talk about that. Oracle slipped 5% following a regulatory filing that showed the company was aiming to raise $18 billion in debt. Intel rose 2% a day after Bloomberg News reported that the chipmaker has approached Apple about securing an investment. IBM rose 3% to top the benchmark index after the partnership with HSBC for trial use of quantum computers to aid bond trading yielded promising results. Switching to BYD. BYD outsells Tesla in EU for second month. Stellantis returns to sales growth. Chinese EV maker BYD sold 3 times as many new cars in the EU last month than in August 2024, surpassing U.S. competitor Tesla for the second consecutive month. Data from the European Auto Lobby, ACEA, showed on Thursday. Stellantis returned to sales growth in Europe for the first time in over a year as the overall market expanded with a boost from plug-in hybrid and battery electric vehicle sales. Europe's battery car industry faces challenges, including U.S. import tariffs, competition from China, and difficulties in profitability meeting domestic regulations for EV adoption. Car makers have ramped up PHEV sales to comply with emission standards with more affordable and more profitable cars than pure EVs. Chinese brands have also used the technology to minimize the impact of European Union's tariffs on Chinese-made EVs and win over China-skeptic European drivers. Sales in the EU, Britain, and European Free Trade Association rose 5% to 0.8 million cars in August, the data showed. Registrations of Volkswagen and Renault rose 4.8% and 7.8% year-on-year, respectively, and were up 2.2% at Stellantis. Tesla's EU sales dropped 37%, squeezing its market share from 1.2 to 1.2 from 2% a year ago. BYD sales were up 200% to give it a 1.3% of the market. That's incredible growth by BYD and as in line with what we're expecting. CarMax stock plummets after missed Wall Street expectations. Shares of CarMax were down by more than 20% in early trading Thursday after the used auto retailer missed Wall Street's quarterly earnings and revenue expectations. CarMax shares were trading early Thursday under $45 a share, the stock's lowest price since March 2020, when the coronavirus pandemic closed down U.S. auto production and many retailers. The stock is down around 46% this year, with a less than $6.7 billion market cap. The company's results included an EPS of 99 cents and revenue of roughly $6.6 billion, down 6% from a year earlier. Analysts surveyed had expected earnings per share of $1.05. Other key results, such as sales and net income, were also down compared with a year earlier. The company's overall vehicle sales fell 4% compared to the same period a year earlier, assisting a roughly 28% decline in net income. CarMax CEO Bill Nash described the company's second fiscal quarter that ended August 31 as challenging in the company's quarterly release. He cited changing market conditions, a pull ahead in sales earlier in the year due to tariff fear buying and depreciation in its inventory fleet as some reasons for the company's lackluster performance. Switching to Xiaomi. Billionaire Xiaomi's founder debuts a $630 answer to the iPhone 17. Xiaomi Corp's billionaire co-founder unveiled a $630 smartphone designed to take on just-released iPhone 17, underscoring the Chinese company's broader ambitions to take on U.S. rivals from Apple to Tesla. The Xiaomi 17, which will be offered in Pro and Pro Max models, just like Apple's Marquee series, starts at $631 for most basic model, rising to 6,000 yuan at the top end. Co-founder and CEO said in a live-streamed event on Thursday. That's more than $100 cheaper than the base iPhone introduced just weeks before Apple's annual product launch event. Lee is going after longtime foe Apple in the most direct fashion, shifting Xiaomi's branding and timing to measure his products against the US company's best. In a 2-hour online presentation, the CEO orchestrated a side-by-side comparison with the iPhone on battery life, display quality, and camera capabilities. On Thursday, Lee also pitted his cars against Tesla's, singling out the Model Y. Xiaomi is riding high after a successful initial expansion of its EV helped triple its market value over the past year. He again sketched out his company's years-long research effort into unlikely arenas from cars to chips. The 55-year-old entrepreneur has previously outlined plans to create AI models and spend $7 billion developing its own mobile processors, part of a broader effort to drive Xiaomi beyond the consumer gadgets it's known for. Lee, who has called EVs his last big entrepreneurial adventure, is trying to transform and elevate a company that started out by undercutting the iPhone. We've undergone a profound transformation over the past 5 years, and today a completely new Xiaomi stands firmly in front of a new era, he said, of Xiaomi's evolving business portfolio. Beijing-based Xiaomi is aggressively pushing for a bigger slice of the premium segment, but confronting Apple means taking on a US company that controls 62% of premium smartphone sales globally, comprising handsets costing $600 or more. Xiaomi has only single-digit share, according to research. Now worth close to $200 billion as investors bet on its expansion into EVs, Xiaomi has carved out a space for itself in a market dominated by Shenzhen-based BYD and Elon Musk's Tesla. By the June launch of its second car, the YU7 SUV, Xiaomi's first model, was outselling the Tesla Model 3. That was slightly more than a year after first deliveries, starting in spring of 2024. Incredible company. Moving on to CoreWeave. CoreWeave strikes $6.5 billion deal with OpenAI to power next-gen AI models. Cloud computing provider CoreWeave rebounded from an initial drop in morning trading on Thursday after announcing a fresh $6.5 billion deal with OpenAI, adding to an already multi-billion-dollar set of agreements with the ChatGPT maker. CoreWeave lost 5% in pre-market trading. It quickly rebounded to a gain of more than 1% in the first hour after the opening bell Thursday morning as the market digested news of the new agreements, which now brings the value of the company's joint agreements to $22.4 billion. New Jersey-based CoreWeave provides cloud computing infrastructure specifically designed for tasks requiring massive amounts of GPU processing power, like training machine learning and AI models. This fresh deal promises OpenAI additional computing power needed to train and operate its AI models on top of what CoreWeave already provides the AI giant. The two companies signed an initial agreement for computing power last March for $11.9 billion, then added a $4 billion agreement in May. Moving on to XAI. Musk's XAI accuses rival OpenAI of stealing trade, trade secrets. Elon Musk's artificial intelligence startup XAI has sued rival OpenAI in California federal court for allegedly stealing its trade secrets to gain an unfair advantage in the race to develop AI technology. The lawsuit filed Wednesday said that OpenAI was engaged in a deeply troubling pattern of hiring away from XAI employees to gain access to trade secrets related to AI chatbot Grok. OpenAI is targeting those individuals with knowledge of XAI's key technologies and business plans, including XAI's source code and its operational advantages in launching data centers, then inducing those employees to breach their confidentiality and other obligations to XAI through unlawful means, the lawsuit alleged. Spokespeople for the companies did not immediately respond to the request for comment. XAI said it discovered the alleged campaign to undermine the company while investigating allegations of trade secret theft against former engineer Lee, who it had accused of taking confidential information to ChatGPT Maker in a separate lawsuit. Lee has not yet responded to allegations. XAI has separately sued Apple in federal court for allegedly conspiring with OpenAI to surpass rival platforms. Apple has not yet responded to the lawsuit. Musk is also suing OpenAI over his conversation for a for-profit company, while OpenAI has countersued Musk for harassment. XAI's new lawsuit is part of a broader legal battle between Musk and OpenAI, which he co-founded, and underscores a high-stakes race in Silicon Valley to hire AI-related talent and gain market share in the burgeoning industry. According to the complaint, OpenAI hired away former company engineer and an unnamed senior finance executive, in addition to Lee, in order to obtain XAI trade secrets. Frazier, who is not a defendant in the complaint, could not be immediately reached for comment. Sounds like bullshit to me. Starbucks announces plans to cut another 900 jobs and close more stores as its turnaround struggles continue. Starbucks announced plans to close unprofitable locations and cut corporate jobs as CEO Brian Niccol focuses on the company's turnaround plan. In a letter posted to this blog and sent to employees on Thursday, Niccol shared that the company plans to eliminate 900 non-retail roles and close open positions as part of a $1 billion restructuring effort. The memo said employees will be notified on Friday and will offer severance and support packages, including benefits and extensions. We will continue to carefully manage costs. We will continue to carefully manage costs and stay focused on the key areas that drive long-term growth, Niccol wrote. This comes after the company laid off 1,100 employees earlier this year. Niccol said the company plans to use the savings to invest in the stores by adding more customer service employees. Other investments include new coffee house designs and innovations. Corporate employees, including support partners and people managers, are now required to come to the office 4 days a week, starting September 30th, Niccol said in July. Moving on to Trump. U.S. medtech stocks fall as Trump administration opens import probe. U.S. medtech stocks fell on Thursday after the U.S. Commerce Department opened a probe into imports of medical devices, a move that could ultimately lead to tariffs. Companies like GE Healthcare, Becton Dickinson, Stryker, Insulet, Intuitive Surgical, and ResMed were among the worst performers on the S&P Healthcare Equipment Index, down between 3 to 9%. Abbott slipped 2%, Medtronic fell 2%, and the S&P Healthcare Equipment Index dropping 1.6% on Thursday. MedTech shares have been volatile this year, pressured by supply chain disruptions, cost inflation, and slower demand in some international markets. Analysts said the probe could have implications for a range of medical technology companies with globally sourced supply chains and could create a modest overhang in the stocks. Moving on to Amazon. Amazon to pay $2.5 billion to settle Prime deception allegations. Amazon.com will pay $2.5 billion in fines and redress the Prime subscribers to settle the U.S. Federal Trade Commission's case alleging the retail juggernaut signed users up for a subscription without their consent and made it difficult to cancel, the FTC said on Thursday. Of that, $1.5 billion will go into a fund to repay eligible Prime subscribers, the FTC said. Now, moving on to macroeconomics. Mortgage rates haven't lifted home sales much yet. So far this year, home sales are on track to set a fresh 30-year low. Sales of existing homes were nearly flat in August, the latest sign that high prices and limited mortgage rate relief are keeping prospective home buyers sidelined for now. Sales dropped 0.2% last month compared to July, to a seasonally adjusted annual rate of 4 million, according to National Association of Realtors data released Thursday. Economists had been expecting a slightly bigger 1.5% decline. So far this year, home sales are tracking slightly below last year's levels, putting the market on pace for another year of sales at or near 30-year lows. Lawrence Yun, the NAR's chief economist, said he expects sales in the fourth quarter to be better than last year if mortgage rates stay near current levels. The all signs point to another weak year for sales. We may be slightly above last year or slightly below, you said. The meaningful interpretation is that the past 3 years have been the lowest, most sluggish home sales since 1995. Home sales rose month over month in the Midwest and West, but dropped in the Northeast and the South. All regions of the country saw home prices rise from last year. The median home in the U.S. sold for $422,600 in August, up 2% from a year earlier. The slow sales are the latest sign that would-be homebuyers are struggling to find affordable options at today's prices and mortgage rates. Moving on to U.S. economy expanded at a surprising 3.8% pace in significant upgrade of second quarter growth. An uptick in consumer spending helped the U.S. economy expand at a surprising 3.8% from April through June, the government reported in a dramatic upgrade of its previous estimate of second quarter growth. The U.S. gross domestic product, the nation's output of goods and services, rebounded in the spring from a 0.6% first quarter drop caused by fallout from President Trump's trade wars, the Commerce Department said Thursday. The department had previously estimated second quarter growth at 3.3%, and forecasters had expected a repeat of that figure. The first quarter GDP drop, the first retreat of the U.S. economy in 3 years, was mainly caused by a surge in imports, which are subtracted from GDP, as businesses hurried to bring in foreign goods before Trump could impose sweeping taxes on them. That trend reversed as expected in the second quarter. Imports fell at a 29% pace, boosting April-June growth by more than 5 percentage points. Consumer spending rose at a 2.5% pace, up from 0.6% in the first quarter and well above the 1.6% the government previously estimated. Spending on services advanced at a 2.6% annual pace, more than double the previous estimate. The U.S. consumer remained a lot stronger than many thought, even in the midst of a stock market sell-off and a lot traded uncertainty, chief economist at Navy Federal Credit Union posted on social media. A category within the GDP data that measures economy's underlying strength came in a stronger previously reported as well, growing 2.9% from April to June, up from 1.9% in the first quarter, the government's estimate. This category includes consumer spending and private investment, but excludes volatile items like exports, inventories, and government spending. Moving on to the Fed. The Fed rate divide deepens as policymakers disagree about more cuts. The rate debate inside the Federal Reserve is intensifying as policymakers go public with their views about the path ahead for monetary policy. On Thursday, Chicago Fed President Austin Goolsbee and Kansas City Fed President Jeff Schmidt both expressed discomfort with aggressively cutting rates further due to concerns about inflation. At the same time, the Fed Governor Stephen Miran continued with his public campaign to push more rapid cuts. He argued in separate interviews in Fox and Bloomberg that the current level is highly restrictive and poses a risk to the U.S. economy. That's why it's important to start adjusting more quickly rather than less quickly, Moran said Thursday. When monetary policy is in that restrictive stance, the economy becomes more vulnerable to downside shocks. In my mind, there's not really a need to be running that type of risk, he said. Fed policymakers last week cut rates by a quarter point and offered a median estimate of 2 more cuts in 2025, although there was a widespread divergence among individual policymakers. Miran dissented, preferring a bigger cut. And the final news, top economic leaders warn Supreme Court to allow Lisa Cook to remain at the Fed for now. In a brief filed with the court, former Fed chairs and U.S. Treasury secretaries cautioned of erosion in public confidence in the Fed's independence. A group of nation's top former economic policymakers warned the Supreme Court on Thursday not to allow President Trump to immediately remove a member of the Federal Reserve Board, saying such a move would threaten the central bank's independence and erode public confidence in the economy. The influential coalition, which includes the former Fed leaders, past U.S. Treasury secretaries, and other leading economic advisors appointed by presidents of both political parties, urged the court in a new filing to allow the board member, Lisa Cook, to remain on the job while litigation continues. The group includes the former Fed chairs Alan Greenspan and Ben Bernanke, in addition to a long list of former Treasury secretaries, including Janet Yellen, who served under President Joseph Biden, and Timothy Geithner, who served under President Barack Obama, and Henry Paulson, who served under President George W. Bush. In their brief file with the Supreme Court, the groups that allow Mr. Trump to remove Ms. Cook now would upset long-standing protections Congress imposed to insulate the Fed from political pressures and efficacy of U.S. monetary policy. And on that note, thank you very much, everybody, and I will chat with you all next time. Take care.